Okay, good morning, everybody. Welcome to our Thursday call, our Q&A call. We've got Pierre Muller in the house. He's going to chat to us about the FirstRand results. Shaun's going to do the technical update for us, and then we're going to take your questions straight after. So if you have questions ready, then please pop them into the chat for us. You're also welcome to ask your questions in person. I'll stop sharing the screen after the presentation, and then we'll hop into the chat and into the questions. Pierre, take it away.
Thanks, Sarel. Good morning, everyone. So FirstRand released its 2023 financial year-end results. So looking at these results just from an overview, the macro environment, as we know, there's been some credit deterioration, especially in SA on the consumer side, as we see the rising interest rates and inflation impacting the credit quality. Then looking at the valuation front. Sorry, there's an echo, but
Okay, Pierre, talk. Let's see.
Thanks.
Okay. Better? All right.
Yeah, that's better.
Let me go back to the screen then. I think let's start again, Pierre.
Will do.
Let's just get this right. I just want to mute myself before I go into the presentation. Pierre, you'll hand over to Shaun.
Okay. So on an overview of the macro environment, so we know with the rising interest rates and the inflation pressure, there's been a deterioration in credit quality across the banks. On the overall level of most banks, they're trading at lower end of their pricing multiples compared to the histories, and the same is true for FirstRand. FirstRand increased its dividend by 12%. That's in line with the increase in earnings that it reported. We maintain our buy recommendation on FirstRand, and what we change our mind is if the profitability in relative terms compared to peers decreases, as FirstRand has higher profitability ratios, but also is trading at higher valuation multiples. Looking at the overall event now on the results that they reported. So revenue increased by 14%, which is ahead of the increase in expenses of 12%. So that would translate in increased profitability ratios. The net interest income increased by 16%, and that's mainly due to the growth in the average interest earning assets, which was up 13%. The rise in interest rates would have had a lesser extent to the increase, as we can see the net interest margin, which would be impacted by the rise in interest rates, only increased from 4.4% to 4.47%. That's due to FirstRand making use of what they call an asset liability management strategy. So that sets off increases, but also during times of interest rate decreases, then that margin doesn't fall as much compared to other banks. On the operating expenses front, that would mainly be due to your staff costs, as that represents a significant portion. We've seen both headcount and annual salary increases on this front. The impairment charge, which grew 55% on expense basis there, so that's quite in line with what we've seen at peer banks. Although that credit loss ratio of 78 basis points is better compared to peers, and also FirstRand has a through the cycle range of 80 to 110 basis points, so it's even lower than their own range that they set, and this is mainly due to them being quite counter-cyclical in their approach, and after this COVID period they've been more prudent, and we can also see in some of the figures such as on the F&B side, where they show the customer numbers So the customers with income above 450,000 increased by 14%, while the customers below that bracket increased by only 2%. So you can see that shift in that quality or type of assets on that front. Management guided limited outlook. So the return on equity, they expect still to remain in this upper end of their range of 18 to 22%. So we're expecting at least in the next year a 20 to 22% return on equity. They expect that credit loss ratio to deteriorate a little bit. And that's as we see the pressure coming through further on consumers in the year ahead. And they still see loan growth, but it definitely to slow down. But they expect commercial to keep its momentum. On the non-interest revenue, so that net fee and commission income, you can see is the majority of the non-interest revenue at 67%. So that increased by 8%. So some of the main drivers there would have been card commissions increased by 17%. And if we drill down into that net fee and commission income, bank charges is quite a significant portion there. It's about 60% of that 36 billion rands that we see there. So that increased by 9%. So these increases were offset by the expenditure side of this, which increased 13%. The insurance income that benefited from increase in premiums, but also in decreases in the amounts that they paid out. That's due to the COVID impacts dissipating. The trading other fair value income that benefited mostly on the currency trading business, as there was increased market volatility, especially where we saw in Nigeria and Ghana. And then the investment income had some other types of items impacting there. They had a private equity investment that they sold and realized a profit of 1.2 billion there. And then there was also just an accounting type of entry where we see between the lines. So in the investment income, you would see that's quite up a lot, while the share of profit of associates is down. So there was a transaction where they changed the investment from a debt to equity. So the investment income had a gain of 0.7 billion, while the bottom one, the share profit of associates, had a loss there of 0.8 billion. Then we can move to the next one. So here I'll talk to the operating expenses. As I mentioned, the staff costs is the majority of the expenses, and that's for most banks usually. And as we can see here, 62%. And that would be that if you combine the top three lines there, all which relates to staff costs. So the first one, just the normal direct staff expenditure, that 14% increase there would have been partly due to 6% headcount increase and then also 6% annual increases. We see some pressures on the banks, competing for talent and so they mentioned that the continued repricing, high demand, technical skills, and similarly in the IT related staff cost, we saw an increase of 22% there. The other staff related expenditure increased due to an increase in temporary and contract staff. And that's due to for projects and other strategic initiatives that they make use of. And similarly, these professional fees would have increased also due to platform related projects that they have. And computer expenses saw that 15% increase. Some of it would be the headcount increase, as you need more equipment and software and so forth. But also a lot of these computer expenses are priced in other currencies, so weaker rand also drives some of the increase on that front. Then on a share price performance, on the different periods here, so there's quite different outcomes. But if we look at the chart here, which is almost a post-COVID, you could say, FirstRand outperformed the JSE Cap Swix benchmark. And then on the next slide, so lastly, from my side, we just have a buy recommendation. We have an intrinsic value of 90 Rand for FirstRand. and the price to earnings is at the bottom end of its history. So that would be part of the upside that we see if this can improve, and we would expect that should the bond yields be lower going forward as interest rates increase, and so then we could possibly unlock that higher price to earnings multiple going forward. That brings me the end to my slides. I think now I'll hand over back to Shaun for his technical analysis.
Yeah, good morning, everybody. Welcome. Yeah, you can see there the chart of FirstRand shows the price that I rallied yesterday. Obviously, this is based on yesterday's closing prices, but obviously it's also given back. Last I saw was 3.22% this morning. So the share price is still trading far below its 21-day and 40-day moving averages. Those are the red line and the green line right up top there, and as well as the just below its 200-day moving average. You can see that little purple line there. So I'm calling the medium to long-term trend still bearish, but in the shorter term, you can also see that the share price is testing what I call a support zone. You say it's like like a FirstRand zone between 64.68 and 68.68. So it's bouncing off that area. So you can see yesterday's price was still in that range. Saying that, the MACD indicator, that's the oscillator at the bottom there, you can see it's trading in oversold territory. So it's trading below that zero line, what we call oversold territory. It also looks like it's turning and looks like it's about to give a bullish signal. And that's also confirmed by the other shorter term indicators like RSI and stochastic, which are also oversold and are already bouncing up from these levels. So, you know, I would say it'd be a good idea to start nibbling at these shares at these low prices. And as Pierre said, now the intrinsic value is way above. You can see there above 90 Rand, so it's got a lot of upside potential, and hence our buy recommendation. Cool.
Alrighty, thanks, Shaun. Thank you very much. Thanks, Pierre. Yeah, I've been looking at the share price in the last week since the results came out, and I honestly can't tell you why it's been hit like that. Because in my mind, a double-digit performance by the bank it's a solid performance on headline earnings. Yeah, there was a double-digit increase in costs as well, and the impairments are slightly up, but way below the range that they've set for themselves. So I honestly can't tell you why the market's this mad at FirstRand to hit it down almost $8 since the results came out. But like Pierre said, we do have an intrinsic value of about $90, and we do think that there's a lot of upside potential for this bank. I will now jump into the chat quickly and see whether we've got any questions. Let's see. Clive says, thanks for the presentation. I don't see any questions. Anybody has a question for Pierre? Yeah, it doesn't look like it. Eh? Gosh,
Can you hear me?
Yes, we can. We can. Who is that?
Theo Skuman.
Yeah, please go. Please go ahead. You're welcome.
Just looking at this share now and what's happening in the economy and well, the rest of the JSE for that matter. On the long term, I can't see that all our shares will recover to where they were. So I wonder if one shouldn't relax a little bit on the upper value, mainly due to the structural nature of what's happening in our economy. What do you think about that?
Yeah, thanks. Good question. So, yeah, I definitely agree with, there's tough times looking ahead, and some structural things in our economy that's difficult. But with the markets, it's usually looking forward. So you can argue that's priced in, as we saw that pricing multiple being at the lower end. And then it's a pity I don't have this graph now on this slide, but the banks are, this PE ratios are quite correlated to, so the bond yields, so the 10-year government bond yield. So as you have a higher yield, like it's now quite historically high compared to history as well on that front. So what would decrease that is when we get to maybe a interest rate decrease cycle or timing next year, then that should help drive that PE ratio upwards. So that's where a lot of my let's say forecast, where I expect some return to be. On the earnings front, yes, you are correct. That's going to get then pressure. So if we look at it at two different type of components like that, where I'm expecting to the PE to expand, while the earnings front, that's a bit of a, it's going to slow down. You don't know necessarily how bad the credit deterioration would be, but we're not expecting it to fall through. We still overall it's still positive actually on a growth side, also on the earnings front. Yeah, so I think that's basically how we see it playing out in this environment. And like I said, everything should be priced in already, as we know there's energy problems, transport problems. We know the credit is gonna deteriorate. So that's why you see that at that low range. And as the event happens, then usually, and the interest rates maybe decrease next year, then you see that the price to earnings ratio, when you're in that time period, it should expand. So that's my expectations at the moment.
Thank you, Pierre. Clive says, if you compare price to book ratios, FirstRand's expensive. Do you want to comment on that, Pierre?
That's true. So well, it depends on not so expensive necessarily as Capitec, but more expensive than the other three, let's say, large banks. But then also, if you compare the return on equity, sitting close to 22%, other banks are 15, 18% perhaps. So it's a more profitable bank. Yeah, and it was quite conservative during the post-COVID periods, and now it could it held back, and it's quite counter-cyclical. So now they're able maybe also to put through more growth on. So yeah, no, it's more expensive, but it's justified, and it's part of the things that we keep an eye out, because as long as it remains profitable, then it's at least warranted the higher ratios.
Okay, thank you, Pierre. Dino says it looks like 2/3 of the income comes from fees and commissions, and that only grew by 8%. The other sources of income, the insurance and investment income, grew by a lot more. He says, is that growth trend likely to continue in the next 2 to 3 years? And I think he's referring to the investment income and the insurance stuff, because we know the fees and commissions are kind of sticky money. That's going to continue on that trend. Your take on that, Pierre?
So no, the short answer, no. On the 2 to 3 years, I don't think it will increase at the same rates. If you consider insurance industry overall is benefiting from this post-COVID environment. So as that kind of normalizes now, it shouldn't increase as much. The trading business, that's very hard to predict, what will happen in markets, exactly what events would trigger. But yeah, so that was quite also elevated on the currency side, but there I'm kind of neutral, as one doesn't necessarily know. And then on the other investments, or the other side of it, so on the investment income, that it's possible, because from what I've read from certain sources is that they still have about, I think, about 5 billion or so private equity, realizations that could further improve profits there. But you don't know necessarily what their decisions are. Are they going to sell it? Are they not? So that's a possible front. But like I said, my short answer, no, I don't expect it to be exact same growth in the next 2 to 3 years on that front.
Cool, thanks, Pierre. I see Shaun and Wessel are having a side conversation here. Let's just highlight it for the rest of the people. Shaun says, Wessel says, Shaun, would the share also be positive for CFDs at the moment? And Shaun said, yes, most definitely. Put your stop below the recent lows. So I'm going to pop into Shaun's graph and just show you here. We can see the previous lows before this rally that we saw sort of halfway up the year, that the share was trotting around the 60 Rand level. So yes, Wessel, if you do take a punt around these levels, I think it is a bit overcooked on the sell side after the results. If you do take a punt, then at least put your stop around the 60 Rand level or just below 60 Rand to be sure. It might still retrace there, but you never know. I think I see the other banks are busy bouncing a little bit, so they've had a positive 2 or 3 days. So I think FirstRand will follow suit, and it's just the aftershock of the results and people trying to process that. So if you do nibble at these levels, then you've got a set stop at about $60, if that answers your question. Right, Clive says thanks for the clarification. Any further questions, guys? I don't see anything, so thanks very much. To reiterate, this is our favorite banking stock. We've got an intrinsic value of $90 on it. It is a long-term view because we do manage portfolios over the long term. On the short term, it does look oversold. It's currently at levels around 64 Rand. I think you can take a nibble at 64 Rand with a clear stop below 60 on a short-term trade. Medium to longer term, I think, should be part of a portfolio. And yeah, because of the exposure, we've said it 1,000 times, I think, because of the exposure to corporate loans and guys financing stuff like load shedding solutions and that, we think FirstRand will outperform. So just to reiterate that for you, thank you very much for your input, Pierre. Thanks for your insight. Thank you, Shaun. I hope you all have a great Thursday. Thank you, guys. Cheers.